Before we dive in, please remember that this video is for educational purposes only and is not financial advice. I am not a financial advisor, loan officer, or mortgage broker. The mortgage market changes daily, so please consult with a qualified professional for advice tailored to your specific situation. Imagine two veterans, Sergeant Smith and Sergeant Jones. Both served with honor, both have a 720 credit score, and both are looking to buy a $350,000 home in the same town for their families. On paper, they are identical, but when they get their final loan documents, Sergeant Smith's monthly mortgage payment is $287 less than Sergeant Jones's. That's over $3,400 a year. Over 30 years, that's more than $100,000. The only difference? Sergeant Smith understood a few fundamental secrets about how VA mortgage rates are actually determined, and Sergeant Jones fell for the common myths. Today you become Sergeant Smith. By the end of this presentation, you will have the knowledge to cut through the noise, avoid the traps, and secure the absolute lowest VA mortgage rate possible. This isn't about finding a secret loophole. It's about understanding the system you earned the right to use. A system that, when navigated correctly, is the most powerful home buying tool on the planet. So what's the biggest myth that costs veterans like Sergeant Jones a fortune? It's the belief that the Department of Veterans Affairs sets the interest rates. Let me be crystal clear. The VA does not set your interest rate. They do not lend you money. They do not process your application. The VA's role is to act as an insurance policy for the lender. They provide a guarantee, a promise to the bank, that if you, the veteran, default on your loan, the VA will cover a portion of the lender's loss. That's it. This guarantee is what makes you such an attractive borrower. It removes a huge amount of risk for the bank, which is why they can offer you incredible benefits like zero down payment and no private mortgage insurance, or PMI. But the interest rate itself? That's decided by the private lender, the bank, the credit union, the mortgage company, that is actually giving you the money. This leads us to the second myth, the idea of a single universal VA rate. You'll see it advertised online. Today's VA rate is 6.5%. That's a marketing tactic, not a promise. It's like a car dealership advertising a sports car, starting at a certain price, but the one on the lot has the premium engine, leather seats, and technology package. The rate you are actually offered depends on a whole host of factors. There is no one-size-fits-all VA rate. Your rate will be unique to you, your financial picture, and the lender you choose. And that last part, the lender you choose, is one of the biggest variables you have control over. This is why understanding the forces that shape your rate is not just academic. It's a financial weapon. Think of your final VA mortgage rate as the result of three massive interlocking gears. To get the best outcome, you have to understand how each one turns. We're going to call these the three pillars of VA mortgage rates. Pillar number one is the market. This is the big picture, global economic environment. It's the ocean that all the ships, meaning all the lenders, are floating on. When the tide comes in, all rates tend to rise. When it goes out, they all tend to fall. You, as an individual borrower, cannot control the tide, but you can, and you must understand it. Pillar number two is the lender. This is the specific bank or mortgage company you choose to work with. Every single lender is a different ship on that ocean. Some are giant cruise liners with huge overhead costs, while others are nimble speedboats. They have different appetites for risk, different profit margins, and different ways they package and sell their loans on the secondary market. This is why one lender can offer you a 6.75% rate while another, on the exact same day, can offer you a 6.25% for the exact same loan. Shopping lenders isn't just a good idea. It is the single most effective action you can take to lower your rate. Pillar number three is you, the borrower. This is your personal financial profile. It's your credit score, your debt-to-income ratio, the size of your down payment, even if it's zero, the type of property you're buying, and how many discount points you're willing to pay. These are the levers you can pull on your own ship to make it more efficient and attractive to lenders. For the rest of our time today, we're going to do a deep dive into that first, most powerful pillar, the market. Because if you don't understand the ocean, you'll have no idea why the ships are moving the way they are. When you hear financial news people talk about mortgage rates, they will almost always mention something called the 10-year Treasury yield. What is that? Think of it as the gold standard, the bedrock interest rate for the entire U.S. economy. It's the rate the U.S. government pays to borrow money for a 10-year period. It's considered one of the safest investments in the world. Mortgage-backed securities, which are bundles of home loans sold to investors, compete directly with Treasury bonds for those investor dollars. So when the yield on the 10-year Treasury goes up, it means investors are demanding a higher return for their money. To stay competitive, mortgage rates have no choice but to go up too. When the 10-year yield falls, mortgage rates usually follow suit. If you want a quick 5-second forecast of where mortgage rates are headed on any given day, look at the 10-year Treasury yield. It is the single most important indicator. Now, what makes that Treasury yield move? This is where the Federal Reserve comes into play. There's a common misconception that the Fed directly sets mortgage rates. They don't. The Fed sets something called the federal funds rate, which is the overnight lending rate for banks. It's a very short-term rate. A mortgage is a 30-year loan. The Fed's actions are more like changing the weather than steering your car. Their primary job is to maintain price stability, in other words, to fight inflation, and to maximize employment. When inflation is high, like we've seen recently, the Fed raises the federal funds rate. This makes it more expensive for banks to borrow money, which creates a ripple effect throughout the economy, slowing down spending and hopefully cooling inflation. This action, and even the talk of this action, spooks the bond market. Investors anticipate a slowing economy and worry about inflation eroding their returns, so they demand higher yields on long-term bonds like the 10-year Treasury. And as we just learned, when the 10-year yield goes up, mortgage rates get pulled right up with it. It creates a paradox that you need to understand. Sometimes, good economic news is bad news for mortgage rates. Let's say a new jobs report comes out and it's incredible. The economy added way more jobs than anyone expected. Your first thought might be, great, the economy is strong. But the market's reaction is, a strong economy means more people with money to spend, which could push inflation higher. The Fed is going to have to keep rates elevated to fight that inflation. And boom, the 10-year Treasury yield ticks up, and mortgage lenders start repricing their loans for the worst that very same day. Conversely, if a report shows the economy is slowing down, or that inflation is finally cooling off, the market breathes a sigh of relief. Investors predict the Fed might be able to cut rates in the future. They become more willing to accept lower yields on long-term bonds, the 10-year Treasury yield falls, and mortgage rates get a little bit better. So, you have these massive impersonal forces at play. The global demand for safe U.S. debt, the Federal Reserve's battle against inflation, and the daily drumbeat of economic reports on jobs, manufacturing, and consumer prices. All of this creates the environment, the tide, that determines the general level of interest rates across the entire country for everyone. It's the starting point. It's the wholesale price of money. Understanding this macro picture is your first line of defense. It prevents you from panicking when rates go up for a week, and it helps you identify opportunities when they dip. It allows you to have an intelligent conversation with the loan officer and ask the right questions. You stop seeing the rate as some arbitrary number a lender just makes up, and you start seeing it as the logical result of massive, predictable economic forces. You understand the game. But this is only 1/3 of the story. Knowing the direction of the tide is critical, but it tells you nothing about the specific price you'll pay on your specific ship. The wholesale price of money is not the retail price you are offered. That retail price is set by the lender, and the difference between what two lenders might offer you on the same day can be absolutely staggering. They are all looking at the same market data, so why is one willing to give you a loan for so much less than another? That is the question we must answer next. To understand the answer, we have to dismantle the single biggest myth about VA loans. It's a myth so pervasive, so widely believed, that it costs veterans thousands, sometimes tens of thousands of dollars over the life of their loan. The myth is this, that the Department of Veterans Affairs sets, or at least heavily influences, the interest rate on your loan. This is completely 100% false. Let me say it again so it sinks in. The VA does not set your interest rate. They don't even have a say in it. What the VA does is guarantee a portion of the loan. They essentially co-sign for you. They say to the lender, hey, if you give this qualified veteran a home loan under our guidelines, and for some reason they can't pay it back, we've got your back. We'll cover a piece of your loss. This guarantee is what makes the VA loan so powerful. It reduces the lender's risk to almost zero. And because the risk is so low, lenders are willing to offer incredible terms. Zero down payment, no monthly mortgage insurance. The VA sets the rules of the game, the minimum requirements a veteran must meet, and the standards a lender must follow to have that loan be guaranteed. But the price of the loan, the interest rate, is set entirely by the open market. It's set by the lender. So let's go back to our two lenders. Lender A offers you a 6.5% interest rate. Lender B, on the same day with the same credit score, offers you 5.75%. That's a 0.75% difference. On a $400,000 loan, that's a difference of over $200 every single month. Over 30 years, that's more than $75,000 in extra interest payments for the exact same house. So why the massive difference? It comes down to three things: the lender's business model, their risk tolerance, and their profit margin. Let's think about it like buying a car. You can go to two different dealerships to buy the exact same model of Ford F-150. Identical truck, identical features. But the price can be wildly different. One dealership is a massive, glittering palace on the busiest intersection in town. They spend millions on Super Bowl commercials. They have a huge sales staff in expensive suits and a fancy espresso machine in the waiting room. The other dealership is a smaller, no-frills operation out by the highway. They have a modest showroom, a smaller staff, and their advertising is mostly word of mouth and local radio. Who do you think has to charge more for that F-150 to stay in business? The palace, of course. They have enormous overhead: the rent, the marketing, the salaries, the free coffee. All of that gets baked into the price of the truck. The no-frills dealership has a leaner operation. Their costs are lower, so they can afford to sell the same truck for less and still make a healthy profit. Mortgage lenders are exactly the same. They are not all created equal. You have your big national banks, the glittering palaces. They have thousands of physical branches, huge marketing budgets, and they offer every financial product under the sun, from checking accounts to credit cards to wealth management. Mortgages are just one small part of their massive business. And because of their high overhead and the fact that VA loans are a niche product for them, their rates are often not the most competitive. They have to price their loans in a way that helps pay for everything else they do. Then you have what are called direct lenders or mortgage bankers. These companies are more specialized. They primarily or only do mortgages. Think of them as the Ford dealership that only sells trucks. They are leaner than the big banks. Their staff are mortgage experts, not general bankers. Because they're more focused and have lower overhead, their rates are often significantly better than what you'll find at a big bank. But then there's a third category, the one many veterans don't even know exists. These are mortgage brokers. A broker doesn't work for one single lender. Instead, they act as an intermediary. They are your personal shopper for a mortgage. They take your loan application and submit it to dozens of different wholesale lenders. Lenders who don't have public-facing loan officers and don't advertise. These wholesale lenders are the leanest of all. They are the no-frills warehouses. They compete fiercely with each other on price to win a broker's business. The broker's job is to sift through all these wholesale offers and find you the absolute lowest rate and best terms available on the market that day. This is often where veterans find the absolute rock-bottom rates, the ones that are a full half point or more below what a big bank might quote. The business model of the lender you choose is the single biggest factor in the rate you will pay. The second factor is risk tolerance, which in the mortgage world translates to something called overlays. Remember, the VA sets the minimum guidelines. For example, the VA itself doesn't actually have a minimum credit score requirement, but almost every lender does. A lender might say, "We know the VA doesn't require a minimum score, but our company policy is that we won't lend to anyone with a score below 620. That extra rule, the one the lender adds on top of the VA's rules, is called an overlay. Lenders use overlays to manage their own internal risk. A very conservative, risk-averse lender, often one of those big banks, might have a ton of overlays. They might require a 660 credit score, or have stricter rules about your debt-to-income ratio, or demand extra documentation. They are cherry-picking only the safest borrowers. Other lenders who specialize in VA loans and truly understand the power of the VA guarantee have fewer overlays. They're comfortable lending right down to the VA's actual guidelines. How does this affect your rate? Well, if you're a veteran with a 630 credit score and you go to that big conservative bank, they might see you as a risky borrower according to their internal rules. So, if they approve you at all, they'll price that perceived risk into your interest rate. They'll hit you with a higher rate to compensate. But if you take that same 630 credit score to a specialized VA lender with no credit score overlay, they don't see you as risky. They see you as a qualified veteran who meets the VA guidelines. And because they perceive less risk, they can offer you a much better rate. Your borrower profile didn't change, but the lender's perception of it did. And that made all the difference. Finally, we have the third piece of the puzzle: the lender's profit margin. Every lender is a for-profit business. The interest rate they quote you isn't just the base cost of the money. It includes their profit, which is sometimes called a yield spread premium. It's the lender's cut. And just like with any business, different companies have different profit strategies. Some lenders operate on a high-volume, low-margin model. They want to do as many loans as possible, and they're willing to make a smaller profit on each one to win more business. They know that by offering incredibly competitive rates, they'll attract more borrowers. These are the lenders who are constantly fighting to be at the top of the rate charts. Other lenders have a high-margin, low-volume model. They don't do as many loans, so they need to make more profit on each one. They might rely on an existing customer base, brand recognition, or simply hope that borrowers don't shop around. They know that many people will just walk into their local bank branch and take the first rate they're offered, without ever realizing they could be saving hundreds of dollars a month elsewhere. So when you see that staggering difference between lender A's 6.5% and lender B's 5.75%, you're not seeing a mistake. You're seeing these three forces at work. You're seeing the difference between a high-overhead, conservative, high-margin lender and a low-overhead, aggressive, low-margin lender. One has built a business model that requires them to charge you more for the exact same product. The other has built a business model that allows them to charge you less. It has nothing to do with the VA, and everything to do with the fundamental principles of business. Understanding this is the key that unlocks the entire system. It transforms you from a passive rate taker into an informed rate shopper. You now know that the goal isn't just to get a loan. The goal is to find the right type of lender whose business model is aligned with your goal of securing the lowest possible rate. But knowing why the rates are different is only the first half of the battle. The second, and arguably more important half, is knowing exactly how to shop for them to force lenders to compete for your business. Most veterans make a critical mistake in the first 10 seconds of their first phone call with a loan officer. A mistake that locks them into a higher rate from the start. But there is a way to avoid it, a strategy that flips the script and puts you in the driver's seat. And that is precisely what we are going to break down next. The strategy is deceptively simple, yet almost no one does it right the first time. It comes down to one fundamental shift in your approach. You must get fully approved for the loan before you ever start shopping for an interest rate. Let me say that again because it goes against everything you've probably heard. Get fully, formally underwritten pre-approved with one lender first. Then, and only then, do you use that approval as leverage to make other lenders compete for your business. This flips the entire power dynamic. Think about the typical home buying journey for a veteran. They get excited, they start looking at houses on Zillow, and the first thing they do is call 3 or 4 different mortgage companies and ask the one question they think matters most. What's your rate today? On the surface, this feels smart. It feels like you're doing your due diligence, like you're comparison shopping. But what you don't realize is that you've just walked straight into the lender's trap. It's a trap not born of malice but of business. And you need to understand the rules of the game they're playing. When you call a loan officer out of the blue and ask for a rate, they have almost zero information about you. They don't know your credit score, your debt-to-income ratio, your work history, or the type of property you want to buy. They know nothing. So what rate are they going to quote you? They're going to quote you the absolute best-case scenario, rock-bottom, perfect borrower rate. The par rate. The rate that might only be available to someone with an 820 credit score, 20% down, which you don't need for a VA loan, and zero debt. They quote you this fantasy number for one reason: to get you to submit an application with them. Their job is to get you in the door. The rate is the bait. So you hear a fantastic rate, say 5.75% from lender A. Then you call lender B, and they quote you 5.875%. You call lender C and they say 5.75% too. Naturally you think, okay, lender A and C are the best deals. I'll apply with them. You submit your applications. They pull your credit. And then a day or two later, the loan officer from lender A calls you back. And the conversation sounds something like this. Hey, great news, we've got your application reviewed. Now, based on your specific file, your credit score being a 710 and your debt-to-income ratio, your actual rate is going to be 6.25%. Your stomach drops. You feel like you've been had. A classic bait and switch. You got lured in with a fantasy number, and now that they have your file and you've invested time and energy, they hit you with the real rate. And the worst part is they're not technically lying. The 5.75% rate did exist, just not for you. This is the cycle of frustration that traps so many veterans. They waste weeks chasing phantom rates, getting their credit pulled multiple times, and ultimately feeling powerless and confused. But what if you never asked that question in the first place? What if you flip the script? Here's the power move. This is the strategy that puts you in command. First, do your research. But don't research rates. Research lenders. Find a lender that specializes in VA loans. Read reviews from other veterans. Look for a loan officer who is known for communication and education, not just for being a slick salesperson. You are not looking for the cheapest rate right now. You are looking for a trusted partner, a guide who will help you build the foundation of your home purchase. Let's call this lender your anchor lender. You're going to choose one, just one to start. You call this anchor lender and you tell them, I am not shopping for a rate today. I am looking to get a full, rock-solid, underwritten pre-approval. I want to know exactly what I qualify for and have my file ready to go so that when I find a home, I can make an offer with the confidence of a cash buyer. This sentence is music to a good loan officer's ears. It tells them you're serious, you're educated, and you're not just a rate kicker. Then you do the work. You provide them with everything they need. Your last 2 years of tax returns, your W-2s, 30 days of pay stubs, 2 months of bank statements, your DD-214. You give them the whole picture. Your file doesn't just get a once-over from the loan officer, it goes to the back office, to the underwriter. The underwriter is the final decision maker, the person who actually approves or denies the loan. They will comb through your entire financial life. They'll verify everything. This process might take a few days, maybe even a week. But at the end of it, you get the single most powerful document in the home buying process. A legitimate, underwritten pre-approval letter. This isn't some flimsy pre-qualification based on a 10-minute phone call. This is a golden ticket. It's a lender saying, we have examined this veteran's entire financial profile, and we are formally committing to lend them up to, say, for $150,000. Now the game has changed. You're no longer a random person asking for a quote. You are a verified, approved, high-value client. You are a sure thing. Now you go shopping. With your golden ticket in hand, you can now approach lender B and lender C. But your conversation is completely different. You don't ask, what's your rate? You state with confidence, hello, I have a full underwritten pre-approval from another lender for a $450,000 VA loan. My credit score is 710, my file is complete, and I am ready to lock in a rate. Here is my pre-approval letter and my loan scenario. I need you to give me your official loan estimate. I am prepared to move forward with whichever lender can provide the best terms. Do you feel the difference? Do you sense the shift in power? You've transformed the conversation from a hypothetical inquiry into a direct competition. You've made them come to you. You're not asking for a fantasy rate. You're demanding a real concrete offer based on a fully documented file. Lenders know you're serious. They know another lender has already done all the heavy lifting and is ready to close your loan. If they want your business, they can't play games. They have to come in with their best and final offer right then and there. They have to compete on costs, on fees, and on the real interest rate they can offer you, a fully approved borrower. It's the difference between walking onto a car lot with no idea what you can afford and asking for a price, versus walking on with a certified check from your credit union and saying, this is what I'm willing to spend. Give me your best out-the-door price. The salesman treats you very, very differently. By getting pre-approved first, you take control. You eliminate the bait and switch. You force transparency. You make lenders fight for the privilege of having you as a client. This one strategic shift can save you tens of thousands of dollars over the life of your loan, and an immeasurable amount of stress and frustration. This pre-approval letter is your sword and your shield in the home buying battle. But there's a critical piece of the puzzle many people miss. The terms pre-qualification and pre-approval are often used interchangeably by real estate agents and even some lenders. But they are worlds apart. One is a worthless piece of paper. The other is the key to the kingdom. Understanding the difference is not just important, it's essential. And mistaking one for the other is a catastrophic error that can cause your dream home to slip through your fingers at the 11th hour. So what are these two pieces of paper? One is a pre-qualification. The other is a pre-approval. On the surface, they sound almost identical. In reality, they are worlds apart. A pre-qualification is, to be blunt, almost worthless. It's a casual chat. It's you calling a lender or filling out a 5-minute online form and saying, hey, I make about this much, my credit is probably around this number, and I have this much debt. Based on that unverified, self-reported information, the lender gives you a ballpark estimate of what you might be able to borrow. There's no deep dive, no pulling of credit reports, no verification of income. It's a financial handshake in the dark. It's the equivalent of walking onto a car lot and having the salesman say, "Yeah, you look like you could probably afford this one." It means nothing. A pre-approval, on the other hand, is a weapon. It is the single most powerful tool you can have in your arsenal before you even start looking at houses online. This is where the lender does the real work. You provide your pay stubs, your W-2s, your bank statements, your tax returns. You give them permission to pull your full credit report from all 3 bureaus. They will verify your employment. For you as a veteran, they will also verify your eligibility for the VA loan and help you obtain your Certificate of Eligibility, or COE. This is a critical document that proves you have the required service to use the benefit. After an underwriter, a real human being, has meticulously gone through your entire financial life with a fine-tooth comb, the lender will issue a pre-approval letter. This letter isn't a guess. It's a conditional commitment to lend you a specific amount of money, at a specific interest rate range, for a specific type of loan. It is the lender saying, "We have done our homework. We have vetted this person, and we are ready to back them with our money." Now, let's go back to that catastrophic error I mentioned. Imagine this scenario. You get a quick pre-qualification online. It says you can afford a $400,000 home. You're ecstatic. You spend the next 6 weekends dragging your family to open houses. You fall in love with a place. It's perfect. The schools are great. The yard is big enough for the dog. It's close to work. You put in an offer for $400,000, proudly attaching your pre-qualification letter. In a competitive market, the seller might be hesitant, but let's say they accept your offer. Congratulations, you're under contract. Now the real work begins. You go back to your lender to finalize the loan, and for the first time they start asking for the real documents. They pull your actual credit score. And oops, it's not the 740 you thought it was. It's actually a 660 because of a medical bill that went to collections 2 years ago that you completely forgot about. Then they look at your pay stubs, and they see that a good chunk of your income is from overtime. But their underwriting guidelines say they can only count that overtime if you have a 2-year history of consistently earning it, and you've only been at this job for 18 months. So they can't use it. Suddenly, your verifiable income is $10,000 a year less than what you told them. They look at your bank statements and see a recent large deposit that you can't source. It was a cash gift from a relative, but there's no paper trail. The loan officer calls you a week later with a grim tone in his voice. "I'm sorry," he says, "but based on your verified credit and income, we can't approve you for $400,000. The best we can do is $350,000. Just like that, your dream is dead. You can't afford the house. You have to back out of the contract. You've not only wasted a month of your life on a roller coaster of hope and despair, but depending on your contract, you could also lose your earnest money deposit. That could be thousands of dollars just gone." The seller is furious, your agent is frustrated, and you and your family are heartbroken, back at square one. This happens every single day, and it is 100% avoidable. Now let's rewind and play that scenario again, but this time you did it the right way. You spent the time up front to get a full underwritten pre-approval. You worked with a lender who specializes in VA loans. They helped you get your Certificate of Eligibility right away. They looked at your credit and pointed out that old medical collection, and you were able to resolve it before you ever started shopping. They analyzed your overtime pay and told you exactly how much of it would count towards your qualification. They went through everything. After this process, they handed you a pre-approval letter. It's not for a vague amount. It's for a specific verified loan of up to, say, $375,000. It's less than the $400,000 you'd hoped for, but it's a real number. It's a number you can bank on. So you adjust your search. You're not looking at dream homes you can't afford. You're looking at homes you know you can buy. You find a fantastic house listed at $380,000. Because you have a powerful pre-approval letter in hand, you are a strong buyer. You're not a risk. You're a sure thing. Your agent submits your offer for $375, and along with it, a letter explaining that you are a pre-approved veteran, ready to close quickly. The seller has another offer for $380, but that buyer only has a flimsy pre-qualification. Who do you think they're going to choose? The sure thing for $5,000 less, or the risky gamble for $5,000 more? 9 times out of 10 they're taking your deal. Your pre-approval didn't just get you a house. It gave you the negotiating power to win in a competitive situation. The rest of the process is smooth because all the heavy lifting was done up front. 30 days later, you're not heartbroken. You're holding the keys to your new home. That is the difference. It's the difference between hope and certainty, between being a tourist looking at houses and being a serious buyer ready to make a deal. For veterans, this is even more critical. The VA loan has its own unique guidelines, like residual income requirements, that a lender needs to understand. A pre-approval from a VA-savvy lender means they've already calculated this and are confident you meet all the specific VA requirements. It removes an entire layer of uncertainty from the process. So the rule is simple and non-negotiable. Do not pass go, do not look at a single house on Zillow, do not call a real estate agent until you have a rock-solid, fully vetted pre-approval letter in your hand. It is the foundation upon which your entire home buying journey will be built. A weak foundation will cause everything to collapse. A strong one will ensure you can weather any storm the market throws at you. Now that you have this foundational weapon, the pre-approval, what determines the actual numbers on that letter? What's the single biggest factor that dictates the interest rate a lender will offer you? It all comes down to a 3-digit number that has an almost terrifying amount of control over your financial life. It's a number that can save you, or cost you, tens of thousands of dollars over the life of your loan. I'm talking, of course, about your credit score. And how it specifically interacts with the VA loan program is something most veterans get wrong. In fact, there's a massive myth about credit scores and VA loans that we need to bust right now, because believing it could be the costliest mistake of all. So what is this massive, costly myth? It's the belief that the Department of Veterans Affairs has a minimum credit score requirement. I'll say it again because it's that important. The VA itself does not have a minimum credit score. Zero. Zilch. Nada. If you've ever heard someone say, you need a 620 to get a VA loan, what you heard was not a government rule. You heard a lender's rule. And that distinction, that single piece of information, can be the difference between you owning a home and you thinking it's impossible. Believing the myth that the VA sets the score is the costliest mistake because it paralyzes you. A veteran with a 610 score might see a big bank advertising a 640 minimum for VA loans and just give up. They close the laptop thinking, well, the government says I'm not ready. I guess I'll just keep renting. They don't dig deeper. They don't shop around. They accept a single bank's policy as the final word from the entire United States government. And that's a tragedy because that veteran might have been just one phone call away from a different lender who would have said, yes. Here's the truth. The VA provides the guarantee on the loan. They are the insurance policy for the lender. But the lender is the one actually fronting the hundreds of thousands of dollars to buy the house. They are taking on the financial risk. And because it's their money on the line, they get to add their own rules on top of the VA's guidelines. In the mortgage world, we call these lender overlays. Think of it like this. The VA sets the floor, the absolute basic requirements to be eligible for the benefit you earned. Things like having enough entitlement, meeting service requirements, and having a certificate of eligibility. But the lender can build their own walls and a ceiling on top of that floor. Their overlay might be a higher credit score, or a lower debt-to-income ratio, or requiring extra cash reserves. Let me make this real for you. Let's talk about two veterans, we'll call them Sarah and Mike. Both served honorably, both have steady jobs, and both have a credit score of 600. Sarah walks into a major national bank, one she's used for her checking account for years. The loan officer pulls her credit, sees the 600 and says, I'm sorry, Sarah. Our minimum credit score for a VA loan is 640. We can't help you. Maybe try to work on your credit and come back in a year. Sarah, believing the myth, leaves dejected. She thinks the VA has rejected her. She gives up on her dream of buying a home for her family. Now, Mike has the exact same 600 credit score, but he's been doing his homework. He knows about lender overlays. He doesn't go to the big bank. Instead, he finds a mortgage company that specializes in VA loans. The loan officer there pulls his credit and sees the 600. She says, okay, a 600 score. Our overlay here is 580, so you're clear on that front. Now let's take a look at the rest of your file, your income, your payment history, and your residual income, to see how we can get this approved. Mike gets the loan. He buys a home. Sarah's still renting. Same veteran, same score, same government benefit. The only difference was knowledge. Mike knew that the first no wasn't the final answer. He knew he wasn't fighting a VA rule. He was fighting a bank's rule, and he could find a different bank with different rules. So, if the VA doesn't have a score requirement, what is the number you should be aiming for? The answer is, it depends on the lender. Some have a hard floor at 640. Others are comfortable at 620. Many VIA specialist lenders can work with scores down to 580, and in some rare cases even lower. But here's the critical part. Your credit score is not just a pass/fail gatekeeper. It is a direct lever on the interest rate you will be offered. A lender might approve Mike at a 600 credit score, but they will likely offer him a higher interest rate than they would offer a veteran with a 740 score. Why? Because the score is a snapshot of risk. A lower score signals to the lender that, historically, you've been a riskier borrower. To compensate for that increased risk, they charge you more in interest over the life of the loan. Think of it like car insurance. A 19-year-old with 2 speeding tickets is going to pay a much higher premium than a 45-year-old with a perfect driving record. Both can get insurance, but they pay a different price for it. Your credit score is your financial driving record. The better it is, the less you pay. Over 30 years, a 0.25% difference in your interest rate can mean tens of thousands of dollars. That is real money. That's a car, a college fund, a secure retirement. This is why understanding what actually makes up your credit score is not just some boring financial exercise. It's one of the most powerful things you can do to build wealth for your family. So let's pull back the curtain. What are the lenders actually looking at? Most use the FICO score model, and it's not some mystical secret formula. It's based on 5 key factors, and they aren't weighted equally. The undisputed heavyweight champion, making up a massive 35% of your score, is your payment history. Do you pay your bills on time? That's it. It's that simple and that profound. A single 30-day late payment on a car loan or credit card can crater your score by 50 to 100 points, and it stays on your report for 7 years. Lenders see a late payment, especially a recent one, as a giant red flag. It tells them that you're struggling to manage your current obligations. So why would they trust you with a new massive one like a mortgage? The single most important thing you can do for your credit is to pay every single bill on time, every single time. Automate your payments. Set calendar reminders. Do whatever it takes. The second most important factor, at 30%, is your credit utilization. This one trips a lot of people up. It's not about how much debt you have, but rather how much of your available credit you are using. Let's say you have one credit card with a $10,000 limit. If you have a $9,000 balance on it, you are using 90% of your available credit. That's extremely high utilization, and it makes you look risky, like you're living on the edge. Even if you make the minimum payment on time every month, that high balance hurts your score. Now imagine you have that same $9,000 balance, but it's spread across 3 credit cards that have a combined limit of $30,000. Now your utilization is only 30%. You have the same amount of debt, but your score is significantly higher. The rule of thumb is to keep your utilization on each card, and overall below 30%. Getting it under 10% is even better. This is often the fastest way to boost your score. If you have some cash, paying down your credit card balances is a guaranteed way to see a quick jump in your points. Next up, at 15%, is the length of your credit history. This is about how long your accounts have been open. The longer your track record, the more data a lender has to predict your future behavior. This is why you should think twice before closing that old credit card you never use. Even if it's sitting in a sock drawer, as long as it has no annual fee, keeping it open helps the average age of your accounts, which helps your score. Then we have 2 smaller factors, each at 10%. First is credit mix. Lenders like to see that you can responsibly manage different types of credit, what they call revolving credit, like credit cards, and installment loans like a car loan or a student loan. It shows you're a versatile borrower. And finally, the last 10% is new credit. This is about how many new accounts you've recently opened or applied for. If you apply for 5 different credit cards and a personal loan in the span of 2 months, it looks like you're in financial trouble and desperate for cash. Every time you apply, it generates a hard inquiry on your report, which can ding your score a few points for a short time. When you're in the home buying process, it's critical to not apply for any new credit. Don't go finance a new truck or a living room full of furniture until after you have the keys to your house. I have seen loans fall apart at the last minute because a borrower bought a new refrigerator on credit a week before closing. Don't let that be you. So, payment history, utilization, credit age, credit mix, and new credit. That's the whole game. It's not magic. It's just math. And now that you know the formula, you can take control. You can get your free credit report from the official government-mandated site, annualcreditreport.com, and check it for errors. You can focus on paying down high-balance credit cards. You can make sure every single payment is on time from this day forward. Knowing these rules separates you from the pack. It allows you to walk into a lender's office with confidence, not just as an applicant, but as a well-informed partner in the transaction. You now understand the myth, and you understand the reality of what lenders are truly looking for. But a great credit score, while critically important, is only one half of the financial qualification puzzle. There's another number, a simple percentage, that can stop a VA loan application dead in its tracks, even for a veteran with an 800 credit score. It has nothing to do with your payment history, and everything to do with your monthly cash flow. It's called your debt-to-income ratio, and it's the silent gatekeeper we need to expose next. So let's pull back the curtain on this gatekeeper. Your debt-to-income ratio, or DTI, is the single most important number in mortgage lending after your credit score. And frankly, for VA loans, it's often more important. Think of it like this: your credit score is your service record. It shows you're reliable, you follow through, you meet your obligations. It's your history. But your DTI? That's your current mission readiness. It's a snapshot of your financial fitness right now. It answers one critical question for the lender. Can this veteran handle a new major monthly payment without being financially overextended? It's calculated in a deceptively simple way. A lender takes all of your monthly debt obligations, and we'll define exactly what those are in a second, and divides them by your gross monthly income, which is your income before any taxes are taken out. The result is a percentage. For example, if you have $2,000 in monthly debts and you make $6,000 a month before taxes, your DTI is 33%. Simple, right? But the devil is in the details of what counts as debt, and how lenders view that final percentage. There are actually two types of DTI they look at. The first is the front-end ratio. This is just your future housing payment. It includes the principal and interest on the loan, plus 1/12 of your annual property taxes and 1/12 of your annual homeowner's insurance premium. We call this PITI. So if your total estimated PITI payment is $2,500 and your gross monthly income is $8,000, your front-end DTI is about 31%. This number is important, but it's not the main event. The one that really matters, the one that acts as the true gatekeeper, is the back-end ratio. This is the big one. The back-end DTI takes your new, estimated PITI payment and adds it to all of your other monthly debt payments that appear on your credit report. We're talking about your car payment, minimum payments on all your credit cards, student loan payments, any personal loans, and court-ordered payments like alimony or child support. So let's go back to our example. Your PITI is $2,500. Let's say you also have a $700 truck payment and a total of $300 in credit card minimums. Your total monthly debt is now $3,500. We divide that by your $8,000 gross income, and your back-end DTI is now almost 44%. This is where so many veterans get blindsided. Let me tell you a story about a client of mine. We'll call him Sergeant Thompson. Post-Army, got a great job in logistics. Credit score was a stellar 790. He had savings. He did everything right. He found the perfect house for his family near his new job. The lender gave him a pre-approval, no problem. He made an offer, it was accepted, and he was on top of the world. Then, 2 weeks before closing, he gets a call from the loan officer. The dreaded call. The underwriter, the person who gives the final sign-off, had flagged his file. His loan was on the verge of being denied. Thompson was floored. His credit was perfect. He'd never missed a payment in his life. What was the problem? The underwriter had calculated his back-end DTI, and it came in at 52%. For most conventional loans, anything over 45% is a giant red flag, and over 50 is often an automatic no. Thompson's dream was evaporating. But why was his DTI so high? Well, he had his own car payment. He had some student loans he was paying on. But the killer, the one he didn't even think about, was a boat he had co-signed on for his father a few years back. His dad made every payment on time, so Thompson never even thought about it. But because his name was on that loan, that $500 monthly payment counted against his DTI, even though he wasn't the one paying it. It was a financial ghost, and it was about to torpedo his home purchase. This is the rigid black and white world of conventional mortgage lending. A high DTI is like a locked door. But this is where the VA loan program changes the entire game. And if you hear nothing else in this entire series, hear this. The VA loan does not have a hard DTI limit. Let me say that again. There is no magic DTI percentage that automatically gets you denied for a VA loan. This is, without a doubt, one of the most powerful and misunderstood benefits of the program. While conventional lenders worship at the altar of DTI, the VA uses a more holistic, more common sense approach. They look at DTI, sure, but they place a much greater emphasis on something called residual income. This is the secret weapon. Residual income is the amount of money you have left over each month after you've paid your new mortgage, all your other debts, estimated utilities, and federal and state taxes. It's your net take-home pay minus your major obligations. It's the money you have left for gas, groceries, clothes, and everything else life throws at you. The VA's logic is brilliant. They understand that a high DTI for someone earning $200,000 a year is very different from a high DTI for someone earning $50,000 a year. The high-income earner might have a 55% DTI, but they could still have $10,000 a month in residual income to live on. The lower-income earner might have a healthier 40% DTI, but only have $800 left over. Who is the safer bet? The VA says it's the person with more cash left over to handle life. They care less about the ratio and more about the reality of your monthly budget. The VA actually publishes a table of required residual income amounts. It varies based on your family size and the region of the country you live in. For example, for a family of 4 living in the Midwest, the VA might require you to have at least $1,039 left over each month. For that same family in the more expensive Northeast, the requirement might be $1,158. It's a guideline designed to protect you, the veteran, from getting into a home you can't truly afford. It's a financial safety net woven directly into the loan program. So, what happened to Sergeant Thompson? His first lender, who mostly did conventional loans, saw that 52% DTI and was ready to deny the file. But Thompson, thankfully, was referred to a VA loan specialist. The new lender ran the numbers again. They saw the 52% DTI, but they didn't stop there. They did the next step. They calculated his residual income. After accounting for his new mortgage, that ghost boat payment, his car, his taxes, and estimated utilities, they found that Sergeant Thompson still had over $3,000 a month in residual income, nearly triple what the VA guidelines required for his family size and region. The loan was approved. He closed on his house 2 weeks later. The DTI was just a number, a single data point. His residual income told the real story. The story of a veteran who was more than capable of handling his financial obligations. That right there is the power of the VA loan. It's a program built with a different philosophy. It's not about finding a reason to say no. It's about finding a responsible path to say yes. But what if your numbers aren't as clear-cut? What if your DTI is high and your residual income is tight? Are you just out of luck? Absolutely not. Your DTI isn't set in stone. It's a dynamic number that you have a tremendous amount of control over. You can strategically and methodically lower it before you ever submit an application, making yourself the strongest possible candidate for a loan. There are specific debts you should target, simple actions you can take, and common mistakes you absolutely must avoid. Knowing how to prepare your DTI for an underwriter's inspection is like getting the answers to the test ahead of time, and that's the critical intel we're going to cover in our next briefing. Alright, let's get this mission underway. The underwriter's desk is the final checkpoint. It's where your entire financial life gets put under a microscope. But this isn't an interrogation. It's a verification process. And if you know what they're looking for, you can prepare the battlefield to your advantage. Your objective is simple. Present a financial profile that screams low risk and ready for homeownership. The two primary weapons in the underwriter's arsenal are your debt-to-income ratio, or DTI, and a unique VA-specific metric called residual income. Mastering these two concepts is the key to getting that approved stamp. First, let's tackle the one you've probably heard about, the debt-to-income ratio. It's a straightforward calculation. The lender adds up all of your monthly debt payments, things like your car loan, student loans, credit card minimum payments, and any other installment loans. Then they divide that total by your gross monthly income, which is your income before any taxes are taken out. The result is your DTI percentage. For example, if your monthly debts total $2,000 and your gross monthly income is $6,000, your DTI is 33%. Now here's where the VA loan starts to show its unique power. Most conventional loans have very strict, unforgiving DTI limits. You go 1% over, you're out. The VA, however, operates with the general guideline of 41% DTI. I want you to burn that word into your brain, guideline. It is not a hard and fast rule. It is a benchmark. If you are at or below 41%, the path to approval is incredibly smooth. But if you're over at 45, 50, even 55%, the mission is not over. Not by a long shot. And we'll cover exactly how that's possible in a moment. First, let's make sure we're calculating DTI correctly. The debt part of the equation trips people up. It only includes contractual debts that appear on your credit report. It does not include your everyday living expenses like your utility bills, cell phone bill, car insurance, or groceries. An underwriter isn't looking at your Netflix subscription. They are looking at the fixed monthly payments you are legally obligated to make to a creditor. A common mistake is thinking a car loan with only 5 payments left will be ignored. The rule is generally this. If an installment loan has 10 or more payments remaining, it will be included in your DTI. If it has fewer than 10, the underwriter may disregard it, but don't count on it. Always be conservative in your own calculations. So, how do you prepare your DTI for inspection? The strategy is simple. Reduce your monthly debt obligations. The most effective tactic is to target your smallest balances first. If you have a store credit card with a $300 balance and a $25 minimum payment, paying that off completely eliminates that $25 payment from your DTI calculation. It's a small victory, but these small victories add up to win the war. Look for any small, nagging debts you can knock out entirely before you apply. This is far more effective for your DTI than making an extra payment on your giant student loan. You're trying to eliminate monthly payments, not just reduce principal. And this leads to the single most important rule during the entire home buying process. Do not take on any new debt. I cannot say this enough. Do not go out and finance a new truck. Do not buy a living room set on a new store credit card. Do not co-sign a loan for your cousin. From the moment you decide to buy a house until the day you have the keys in your hand, your financial profile is on lockdown. A new monthly payment appearing on your record mid-process can completely torpedo your approval. Now for the VA's secret weapon. The reason the 41% DTI is just a guideline. It's called residual income. This is where the VA loan program truly shows that it was designed by veterans for veterans. While DTI looks at a ratio, residual income looks at cold hard cash. It asks a very simple common sense question. After you pay your new mortgage payment, property taxes, insurance, and all your other debts, do you have enough money left over to actually live? To buy food, gas, and clothes for your family? The VA has a set of standards for this, based on your family size and the region of the country you live in. For instance, the VA might determine that a family of 4 living in the Midwest needs at least $1,003 left over each month to live comfortably. A single veteran in the South might need $441. These numbers are updated periodically, but the principle is the same. The underwriter will calculate your proposed monthly housing payment, add it to your other debts and obligations, subtract that total from your net take-home pay, and then compare the result to the VA's residual income table. This is the game changer. Let's say your DTI is a bit high, maybe 48%. A conventional loan would shut that down instantly, but the VA underwriter sees that even with that 48% DTI, you have $2,000 in residual income, which is double the VA requirement for your family size and region. This demonstrates a powerful ability to manage your money and easily handle your financial obligations. Your strong residual income becomes what's known as a compensating factor. It compensates for the higher DTI. It's you proving with numbers that the DTI ratio doesn't tell the whole story. Strong residual income is the ultimate compensating factor, but there are others that can help you overcome a high DTI. Having significant cash reserves is a big one. If you have 6 months' worth of mortgage payments sitting in a savings account, it shows the underwriter you can weather a financial storm. A long and stable job history in the same line of work also helps, as does a history of consistent promotions or pay raises. Excellent credit is another powerful factor. Even though the VA itself doesn't have a minimum score, a high FICO score tells the lender you have a proven track record of paying your debts on time, making you a lower risk. Think of it like this: your DTI is your initial qualification score. Your residual income and compensating factors are your bonus points. If your DTI is over 41%, the underwriter essentially opens up a secondary checklist. Do they have strong residual income? Check. Do they have cash reserves? Check. Do they have great credit? Check. With enough of these compensating factors, lenders can get comfortable approving VA loans with DTIs well into the 50% range, and sometimes even higher. This is a level of flexibility that is virtually unheard of in any other mortgage program. It's the VA's way of looking at the veteran as a whole person, not just a number on a spreadsheet. So your pre-mission battle plan is clear. First, calculate your DTI as accurately as possible. Be honest with yourself. Second, pay down and eliminate any small high-payment debts you can. Third, go on a debt diet and freeze all new credit until your loan closes. And fourth, calculate your potential residual income. Understand this powerful tool you have at your disposal. Knowing your DTI and your residual income before you even talk to a lender is like having the enemy's playbook. It allows you to identify your own strengths and weaknesses and to strategize accordingly. This is how you walk into the process with confidence. You're not just hoping for an approval. You're building a case for one. You are demonstrating financial readiness. But getting your finances in order is only half the battle. The other half is navigating the market itself. Interest rates are not static. They are a moving target. And when you lock in, your interest rate can have a massive impact on your monthly payment and the total cost of your loan over its lifetime. It's a high-stakes decision that blends data, timing, and a little bit of nerve. And that critical decision, how and when to lock your VA mortgage rate, is exactly what we're breaking down next. So let's dive right into that decision. The rate lock. What is it, really? Think of it as a handshake agreement with your lender, but a legally binding one. You find a rate you like and you tell your lender, that one. I want that one. The lender then locks that rate for you for a specific period of time. Usually 30, 45, or 60 days. This means that no matter what happens in the wild, unpredictable world of financial markets during that window, your rate is protected. If rates suddenly shoot up because of an inflation report or a change in federal policy, it doesn't matter. Your rate is safe, held in place just for you. It's your personal economic storm shelter. This protection is the core reason rate locks exist. The home buying process isn't instantaneous. From the moment you have a signed purchase agreement to the day you get the keys, weeks or even months can pass. In that time, mortgage rates can, and often do, fluctuate daily. Without a rate lock, the rate you were quoted when you started could be completely different by the time you close. Imagine planning your budget around a 6% interest rate, only to find out on closing day that the market rate is now 7%. That single percentage point could mean hundreds of dollars more on your monthly payment and tens of thousands of dollars more over the life of the loan. A rate lock removes that terrifying uncertainty from the equation. It transforms a variable into a constant, allowing you to plan your financial future with confidence. But this brings us to the central dilemma every homebuyer faces: the choice between locking your rate or letting it float. Floating a rate is the opposite of locking it. It means you haven't committed to a specific rate yet. You're choosing to ride the waves of the market, hoping they carry you to a lower rate shore before you have to dock at your closing date. If you float your rate and the market improves, meaning interest rates go down, you're a genius. You've just saved yourself a significant amount of money by waiting. You get to lock in that new lower rate and enjoy a smaller monthly payment. However, if you float your rate and the market turns against you, the consequences can be severe. If rates climb, you're completely exposed. You could be forced to lock in a much higher rate than the one you could have had just a week or two earlier. It's a gamble, plain and simple. So how do you decide? It comes down to a combination of market analysis and a very honest assessment of your own personality. First, your risk tolerance. Are you the kind of person who can sleep at night knowing your future mortgage payment is fluctuating with the whims of the global economy? Or are you someone who needs certainty and a predictable plan? There is no right or wrong answer here, but being honest with yourself is critical. If the stress of watching rates tick up and down every day is going to drive you crazy, the peace of mind that comes with a rate lock is invaluable. For many veterans, the mission is to secure the house for their family. Locking the rate accomplishes that part of the mission with certainty. Trying to squeeze out an extra eighth of a percentage point might not be worth the risk of mission failure. Second, what is the market actually doing? Is there a clear trend? Are rates generally falling? Or are they on a steady rise? Your loan officer is your intelligence officer here. They watch this data all day, every day. Ask them for their professional opinion on the market's direction. Look at financial news. Are there big economic reports coming out soon? Is the Federal Reserve scheduled to meet? These events are like approaching storms that can cause massive turbulence in the interest rate market. If a lot of uncertainty is on the horizon, locking your rate is like deciding to land your plane before the storm hits. It's the safer, more prudent move. If the forecast looks clear and calm with a favorable tailwind, you might consider floating for a little while longer. So, when is the perfect moment to pull the trigger and lock? While there's no magic signal, there are a few key moments and indicators. The most common and logical time to lock your rate is as soon as you have a signed purchase agreement on a home. At this point, you have a property, you have a price, and you have an estimated closing date. You have all the key pieces of information needed to move forward. The clock is officially ticking, and you now have a real, tangible reason to protect yourself from market volatility. Locking at this stage makes the most sense for the vast majority of buyers. Another great time to lock is simply when you see a rate that works for you. Don't get caught in the trap of, what if it goes lower? If the current rate gives you a monthly payment that fits comfortably within your budget and you're happy with it, then lock it in and don't look back. Trying to time the absolute bottom of the market is a fool's errand, even for seasoned Wall Street traders. Securing a good, affordable rate is a win, period. Celebrate that win and focus on the next steps of your home purchase. Now let's talk about the mechanics of the lock itself. Rate locks aren't infinite. They have an expiration date. A 30-day lock is standard, but you can often get 45, 60, or even 90-day locks. Why the difference? Longer lock periods are for more complicated purchases, or for situations where you anticipate a longer closing process, like with new construction. But there's a trade-off. A longer lock period presents a greater risk for the lender, because they are guaranteeing you a rate for a longer stretch of time. To compensate for that risk, they will often charge a slightly higher interest rate or a fee for a longer lock. So, a 60-day lock might come with a rate that's an eighth of a point higher than a 30-day lock. You need to work with your loan officer to choose a lock period that gives you enough time to close without paying for extra time you don't need. What happens if your lock is about to expire but your closing got delayed? This is a common fear, but don't panic. In most cases, you can purchase a rate lock extension. It will cost you a fee, which can be a flat amount or a percentage of the loan, but it allows you to extend your locked rate for a few days or another week. While it's an extra cost you want to avoid, it's almost always cheaper than letting your lock expire and being forced to accept a new, potentially much higher market rate. But what about the flip side? What if you lock your rate and then 2 weeks later rates take a nosedive? This is the moment every homebuyer dreads. You're stuck with your higher rate while your neighbor who waited gets a better deal. Feels terrible, but there is a potential solution. It's called a float-down provision. This is a special feature you can sometimes add to your rate lock, often for an upfront fee. A float-down provision is like an insurance policy. It allows you to lock your rate, protecting you if rates go up. But if rates drop by a certain amount, say 0.25%, it gives you a one-time opportunity to renegotiate and lock in that new lower rate. It's the best of both worlds, but it comes at a cost. Not all lenders offer it, and the terms can vary widely, so you have to ask your loan officer about it specifically if it's something you're interested in. Ultimately, the decision to lock or float is a personal one. It's a calculated risk, but for most veterans using their VA loan benefit, the goal is stability and security. The VA loan program itself is designed to make homeownership safe and accessible. In that spirit, locking in a rate you are comfortable with as soon as you have a purchase contract is the most common and often the wisest strategy. It takes one of the biggest, most stressful variables off the table and lets you focus on the rest of the process. You've made a plan, you've secured your terms, and now you can execute the mission of getting to the closing table. By locking your rate, you've solidified the single biggest factor in your monthly payment. But it's not the only factor. The interest rate is just one piece of the puzzle. To truly understand the cost of your home, you need to look beyond the rate and understand all the other costs and fees that come with it, especially one that is unique and critical to the VA loan program itself. It's called the VA funding fee, and it plays a massive role in how this entire system works. And that's exactly where we're going next. So what is this VA funding fee? Think of it as the engine that keeps the entire VA loan program running. It's the very thing that allows lenders to offer you a loan with zero down payment and no monthly mortgage insurance. It's a one-time fee, paid directly to the Department of Veterans Affairs, and it's the secret sauce that makes this whole system work. Here's why it's so critical. When a private bank lends you hundreds of thousands of dollars, they are taking on a risk. If for some reason you can't make your payments and the loan goes into foreclosure, the bank could lose a lot of money. To protect themselves, they usually require two things: a hefty down payment and private mortgage insurance, or PMI. That PMI is an extra fee you pay every single month, purely to protect the lender, not you. The VA loan flips that script. It tells the lender, don't worry, we've got your back. The VA guarantees a portion of the loan. So in that worst-case scenario of a foreclosure, the VA steps in and repays the lender for their loss. This guarantee is what gives lenders the confidence to lend to you with such amazing terms. But where does the money for that guarantee come from? It doesn't come from taxpayers. The VA home loan program is designed to be self-sustaining, and it sustains itself with the funding fee. Every time a veteran or service member uses their VA loan benefit, the funding fee they pay goes into a central pot of money. That pot of money is then used to cover any losses from the rare loans that do default. It's a brilliant system. It's veterans helping veterans. The fee you pay ensures that the next generation of service members will have the exact same opportunity to buy a home that you do. So, how much is it? This is where it gets specific because the fee isn't a single, flat number. It's a percentage of your total loan amount, and that percentage changes based on a few key factors. The first and most important factor is whether this is your first time using the VA loan benefit. For first-time users, the fee is lower. For what the VA calls subsequent use, meaning you've used a VA loan before, the fee is higher. The logic is that the biggest benefit is given to you on your first go-around. The second major factor is your down payment. While the hallmark of the VA loan is the option for zero down, you absolutely can make a down payment if you choose to, and the VA incentivizes this. The more money you put down, the lower your funding fee will be. Let's put some real numbers to this. For a regular military veteran or active duty service member using the benefit for the first time, if you make no down payment, your funding fee is currently 2.15% of the loan amount. So, on a $300,000 loan, that's $6,450. Now, watch what happens if you decide to put some money down. If you put down at least 5% but less than 10%, that funding fee drops from 2.15% all the way down to 1.5%. On that same $300,000 loan, your fee is now just $4,500. You just saved nearly $2,000. If you can put down 10% or more, the fee drops even further to 1.25%. For members of the Reserves or National Guard, the numbers are slightly higher. A first-time use with zero down is 2.4%. Now, what about that subsequent use? Let's say you bought a home years ago, sold it, and now you're ready to buy again using another VA loan. For your second time around with zero down, the funding fee is 3.3% for all branches. It's a significant jump, but again, making a down payment can drastically reduce it. Putting 5% down reduces that 3.3% fee to 1.5%. So, for a subsequent user, a down payment makes an enormous difference. This fee also changes based on the type of VA loan. What we've been discussing are standard purchase loans. If you're doing a cash-out refinance, the fee structure is similar. But if you're doing an interest rate reduction refinance loan or IRRRL, also known as a streamline refinance, the funding fee is much, much lower. It's a flat 0.5% for everyone, regardless of whether it's your first or fifth VA loan. This is designed to make it as easy and affordable as possible for veterans to lower their interest rate and monthly payment. Now, after hearing all these percentages and dollar amounts, you might be thinking, that's a lot of money to come up with at closing. And you're right. But here's the most common and important feature of the funding fee. You almost never have to pay it out of pocket. In the vast majority of cases, the VA funding fee is rolled into your total loan amount. So, using our earlier example, if you're borrowing $300,000 and your funding fee is $6,450, your final loan amount will be $306,450. You don't write a check for it. It just becomes part of the mortgage you pay off over time. This is a huge advantage. It keeps your cash in your pocket for moving expenses, furniture, or an emergency fund. The downside, of course, is that you are now paying interest on that fee over the 30-year life of the loan. It will slightly increase your monthly payment. We're talking maybe $25 to $35 a month on that $300,000 loan. For most people, that's a very acceptable trade-off to avoid a massive out-of-pocket expense at closing. You do have the option to pay it in cash if you want to, but very few borrowers choose to do so. Now, I've saved the most important piece of information about the funding fee for last, because there is a very significant group of veterans who are completely exempt from paying it. You do not have to pay the VA funding fee at all if you are a veteran receiving VA compensation for a service-connected disability. Let me repeat that because it is critical. If you are receiving disability benefits from the VA, you are exempt. This also applies to veterans who would be entitled to receive compensation, but are receiving retirement or active duty pay instead. And most importantly, it also applies to surviving spouses of veterans who died in service or from a service-connected disability. This is a monumental benefit. On that $300,000 loan, that's an instant savings of over $6,000. The VA and your lender should automatically verify your exemption status, but it is something you must be aware of. If you have a disability claim that is pending when you close on your loan, you might have to pay the funding fee initially. But if your claim is later approved and the effective date is prior to your closing date, you can apply to the VA for a refund of the funding fee you paid. This has put thousands of dollars back into the pockets of veterans who earned it. So, the funding fee, while it sounds like just another closing cost, is actually the bedrock of the entire program. It's what makes the zero down payment and no PMI possible. It's a system funded by veterans for veterans. Understanding how it's calculated, based on your service, your down payment, and your prior use, allows you to strategically plan your home purchase to minimize your costs. And knowing if you qualify for an exemption can save you thousands upon thousands of dollars. It's another one of those unique puzzle pieces like discount points and APR that you have to understand to see the full picture of your VA loan. It's not just about the interest rate you see advertised online. It's about the total cost of borrowing. Now that you understand all the components, the base interest rate, the forces that move it, the true cost represented by the APR, the strategy of using discount points, and the role of the VA funding fee, you have all the individual pieces of the puzzle. But knowledge is only potential power. The real power comes from action. How do you take all this information and assemble it into a cohesive strategy? How do you go out into the real world, compare different lenders, and find the absolute best deal for your family? Because not all lenders are created equal. Far from it. Choosing the wrong lender, one who doesn't specialize in VA loans, can cost you time, money, and immense frustration. In our final part, we're going to build your action plan. We'll show you exactly how to shop for a VA loan, what questions to ask, what red flags to look for, and how to lock in that perfect rate, ensuring the sacrifice you made for our country translates into the best possible deal on the home you deserve. Alright, let's execute this mission. The first step in shopping for your VA loan is to get your gear in order. This is your pre-combat inspection. Before you even speak to a single lender, you need to be mission ready. First, secure your Certificate of Eligibility, or COE. This is the VA's official document proving you qualify for the benefit. You can get this yourself through the eBenefits portal online, or a good VA-savvy lender can pull it for you in minutes. Having it ready shows you're serious. Second, know your intel. That means knowing your credit score. You can get a good idea from free services, but understand that the score a lender pulls will be a bit different. The goal here is to identify any surprise ambushes on your report that you need to address. And third, assemble your dossier. Gather your last 2 years of W-2s and tax returns, your last 2 months of bank statements, and your last 30 days of pay stubs. Having all this documentation scanned and ready to go makes you look organized and allows lenders to give you a fast and accurate quote. Now, with your gear packed, it's time to choose your battlefield. You need to contact at least 3 and ideally 5 different lenders. Do not just walk into your local bank and take the first offer. That's like walking into a gunfight with an unloaded weapon. You want to compare national banks, local credit unions, especially military-focused ones like Navy Federal, and dedicated mortgage brokers who specialize in VA loans. Each has its strengths. A credit union might offer member-specific discounts. A national bank might have streamlined tech. A good broker can shop your loan profile to dozens of wholesale lenders at once, finding niche deals you'd never see otherwise. The key is to create competition for your business. You earn this benefit, make them fight for it. When you make contact, you become an intelligence officer. You are there to gather critical information, and you need to ask the right questions. Don't just ask, "What's your rate?" That's amateur hour. Here is your interrogation script. Question 1. What is your interest rate, and what is your annual percentage rate, the APR? Remember from our earlier discussion, the APR is the truth serum. It includes not just the interest rate but also most of the lender's fees, giving you a more accurate picture of the loan's true cost. If a lender is hesitant to give you the APR, that's your first red flag. Question 2. Can you provide me with a detailed, itemized breakdown of your lender fees? You're looking for specifics. Ask them to list every single charge that is a direct profit for them. This includes the origination fee, processing fees, underwriting fees, and any other junk fees with creative names. You want this in writing. Question 3, and this is a big one. Is this rate quote based on paying discount points? If so, what would the rate be with 0 points? Lenders love to advertise a super low rate, but often that rate is only achievable if you prepay thousands of dollars in interest upfront in the form of points. You need to compare apples to apples. Always ask for the 0-point option so you have a clean baseline to compare between lenders. Question 4. What is your estimated VA funding fee? While this fee is set by the VA, not the lender, asking this question tests their knowledge. An experienced VA lender will ask you clarifying questions. Is this your first time using the VA loan? Are you receiving VA disability compensation? If they just throw out a number without asking, they might not know what they're doing, which can cause major problems later. Question 5. What's your average closing time for a VA loan? From application to funding? The answer you're looking for is typically 30 to 45 days. If they say 60 days or more, or if they hedge and can't give a straight answer, it's a sign they might be slow or understaffed. In a competitive housing market, a slow lender can get your offer rejected or kill your deal entirely. And a final crucial question. If I move forward with you, who will be my single point of contact? The last thing you want is to be shuffled around a call center, re-explaining your situation to a new person every time you call. A dedicated loan officer who you can call or text directly is worth their weight in gold. Once you've asked these questions to your 3 to 5 lenders, you'll request an official loan estimate from each of them. This is a standardized 3-page government form, and it is your ultimate comparison tool. This document forces lenders to lay their cards on the table in the same format. The most important section for you is on page 2. Box A, origination charges. This box shows you the pure profit the lender is making. This is the number you use to pit lenders against each other. Lay the loan estimates out side by side. Compare the interest rates. Compare the APRs. Compare the cash you need to bring to closing. The best deal will become crystal clear. As you do this, keep your radar on for enemy tactics. Watch for the classic bait and switch. A lender quotes you a phenomenal rate over the phone, but the official loan estimate comes back much higher, loaded with fees. They hope you're too far into the process to back out. Don't fall for it. Another red flag is high-pressure sales. If a loan officer tells you, "This rate is only good for the next hour, you have to lock in right now," hang up. That's not a financial advisor. It's a used car salesman. A professional will give you time to review your loan estimate and make an informed decision. Finally, trust your gut. If a lender is evasive, can't explain their own fees, or seems unfamiliar with VA-specific terms like residual income or VA appraisal process, they are not the expert you need on your team. Using an inexperienced lender for a VA loan is a recipe for disaster. Once you've chosen your lender and you have a signed contract on a house, it's time to lock in your rate. A rate lock is a lender's guarantee to hold a specific interest rate for you for a set period, usually 30 to 60 days, while your loan is processed. This protects you if market rates go up before you close. Before you lock, ask one more question. Do you offer a float-down option? A float-down allows you to take advantage if rates happen to drop significantly during your lock period. Some lenders offer it for free, some charge a small fee, and some don't offer it at all. It's an important piece of intel to have. And here's the final move, the one that separates the rookies from the veterans. You can negotiate. Take the best loan estimate you received and go back to the lender you like the most. Say to them, "I'd really prefer to work with you, but lender X has offered me the same rate with $1,000 less in origination fees. Can you match that?" The worst they can say is no. But in many cases, they will fight to win your business. They might waive a processing fee or offer a small credit. That's hundreds or even thousands of dollars that stay in your pocket, all because you did your homework and weren't afraid to ask. This entire process, from gathering your documents to negotiating the final fee, is about taking control. The VA loan isn't a handout. It's a benefit you earn through sweat, through sacrifice, through service. It is one of our country's most tangible ways of saying thank you. But it is up to you to be the disciplined, intelligent, and proactive steward of that benefit. By shopping for your mortgage with the same diligence you'd apply to a mission, you honor your own service. You ensure that the benefit designed to help you build wealth and stability does exactly that. This isn't just about finding the lowest number on a spreadsheet. This is about securing the keys to your future. It's about the home where your kids will grow up, the backyard where you'll host barbecues, the piece of this nation you fought to defend that you can finally call your own. You have the tools. You have the knowledge. You have the right. Now go out there and claim the dream you so rightfully deserve. Thank you for your service, and thank you for letting us be a part of your homeownership journey. If this guide has helped you, please do us a favor and share it with another veteran who could use this information. It's how we look out for each other. Subscribe for more content designed to help our military community thrive. And leave a comment below with your own questions or your VA loan success story. Let's build a community of informed veterans together.